Hello, everybody. I welcome you all to this lecture on bank reconciliations. Sometimes it is called bank reconciliation statements, okay, depending with the authors of this financial accounting. Um, the basic uh, task which we are going to accomplish by the end of the lecture is for us to know how to prepare a bank reconciliation statement, as well as to understand uh, its link, okay, the link between the bank reconciliation statement and the cash book of an entity. All right, you know my name. These are my credentials, and you have to feel free to contact me anytime, okay, using this number or just this email. You can also use the business email, that is the transcar@gmail.com. All right, feel free. You are our student. We have to ensure that we meet your expectations, we attend to your queries, to your needs, everything else. So you just have to feel free to contact us anytime. All right, without wasting much of your time, let us go straight to the business. So these are our objectives. They're just two, okay? We have to identify and deal with cash book discrepancies. Here, we're just referring to the errors or disparities. Sometimes during the course of the week or the month, we might make errors when we complete the cash book, or we may there might be certain transactions which might render our cash book uh, explaining things which are different from the bank, because the cash book, okay, the cash book is an internal tool by the managers to account for the entity's money, whilst the bank or the banker is there to safeguard that money. Okay, let's say we have received money, we recorded that money in the cash book, and then we have to bank it. Okay, so the balance that is in the cash book should actually tally with the balance at the bank. But so many things would have happened which might cause these balances, the balance at the bank. Okay, we have to worry about the balance at bank and according to our record, according to record. And when we say according to the record, we mean according to the cash book. So these balances should actually be the same. Okay, they should tally, but in they should tally in theory. Okay, but on the ground they never tally. Okay, they never tally. So if they don't tally, we have to consider, we have to know why. So those items which will explain the difference are called reconciling items. Reconciling items. Okay, and what are these reconciling items? Reconciling items are only two. Okay, are only two, and we'll discuss about those ones. These are only two. Okay, these are only two. Of course, in practice, again, you will discover that it depends on the entity. Some entities, because these days, because of technology, we no longer have checks. Checks are now very rare, especially in Zimbabwe. Okay, but in other countries, they're still there. Remember, this is a global qualification. So, in other economic landscapes or other markets, other countries, they are still operational. The checks, they are still operational, but they are actually usually the the business issues which give rise to the discrepancies between the cash book and the bank statement. All right. So we are going to discuss about that. Then the other objective is to reconcile a bank statement with the cash book. Then in other words, we should know how to prepare a bank reconciliation statement by the end of the day. Now, I've typed something here I want you to appreciate. Okay, I want you to appreciate that thing before we go any further. I know you have all the notes. Okay, so we are not going to dwell much about reading those notes for you, because my work is not is not to take you through the notes word by word, but just to explain the major things I feel you need to know. Okay, so that you understand those notes very, very effectively. All right, we talked about the cash book. Let's discuss here. Let's agree or disagree. Okay, a cash book looks like this. Just in general sense, although we have got sophisticated cash books with extended entries and so forth. All right, but for now, let's just consider a cash book as a cash account. This is the cash account of the business. Cash account of the business. All right, a cash book actually explains our PL's acronym. If you still remember the PL's acronym, Okay, the PL's acronym, we say that it is also divided in the middle like this. And we say that on this side there is a debit and this side a credit. And we say that the P stands for purchases, E stands for expenses, A stands for assets. And then R stands for revenue, L liabilities, S share capital, etc. Okay? Now, all these guys, the PEA, they are increased by debiting, while the RLS is or are increased by crediting. When we want to reduce the PEA, when we want to reduce these guys, we can only do that by crediting them. On this side again, when we want to reduce the RLS, when we want to reduce them, we debit. Okay? There we are done. All right. Now, let's come back to our cash book. The cash book is a cash account. All right? It also has got a debit and a credit. The debit simply means that we have received something. We have received the cash. And the credit simply means that we have paid. We have paid out cash. Paid out. For the credit is for payment. The debit is for receipts. Now, let's say we have received money from a customer. Let's say a customer, okay? A customer, we sold, okay? Let's say we sold bread for $1, okay? Bread $1 for cash, okay? Bread $1 for cash. All right. What happens is we debit cash, okay, and credit sales. We have made some sales. We have sold. All right. So in our cash book, we're going to say debit cash. How much? $1. Remember, this is a column for dollars. Okay. So you've got a column here, the dollar sign. That's our cash book, okay? But it doesn't mean that when we say we have sold, we have made a sale, it doesn't mean that in the cash book we are going to say to write $1 here and then on this side we write sales. It doesn't mean that transactions you are seeing on the debit are going to be the same on the credit. It doesn't work like that. Okay? It doesn't work like that. Okay? We might be having other issues here which we could have done, but doesn't mean that on this side of the cash book we are going to open similar entries. It doesn't work like that. Please get me right. So this is just a recap of the cash book. We discussed about this one in previous lectures, but I just wanted to point out here. On this side, we might have paid, let's say, salaries to employees, let's say $80. It doesn't mean that on the debit side we have received an equal amount of $80 for salaries. It doesn't work like that, because the cash book only records the cash that has been received by the business, okay, or that has been paid by the business, but it doesn't mean that you receive and automatically pay, no, or you pay and automatically receive. It doesn't work like that. All right, but the most important point again to note is that in this cash book, the cash book balance, let's say we made another entry here for, let's say, $80 for something, money which we have received, let's say, from a customer again, okay? Then by the end of the day, the cash book is balanced, all right? The cash book is balanced, okay? Let's say on the 1st of this month again, we had an opening balance, okay? Opening balance of, say, $90. All right, but on this, we only paid for salaries. So what happens is we have to add up the cash book, or to balance up the cash book. Now, remember that this being a cash account of the business, it should be balanced by the end of the month or the week. It depends with the company. All right, it should be balanced. An account should be balanced by the end of the period. So we have to balance up the account. So how do we do it? We have to add both sides, the debit and the credit. They have to be added, and these grant totals should balance for, in either side or on both sides, they should balance. So if we add up 90 plus 1 plus 8, we get 99. And then, so this side, before you write your 99, you have to ensure that you can just put the 99 as a temporal figure, because you also have to verify that whether the credit side is lower than 99. So if it is lower, like for example, in this case, we add up and we find that it is 80. So we just have to write 99, the larger figure on both sides. Okay, the larger of both sides. So now, but the rule is the account should balance. So to ensure the credit side has come to 99, we just have to find the difference. And the difference is what we call the balance CD, which is 9. So what does this CD mean? It means that the cash book at the end of the month had a $9 outstanding or extra money. Okay, this is going to be carried forward to the next period as an opening balance. Here it is a closing balance. Okay, this is the closing balance, and this is the opening balance for the next period. Opening balance of 9. Okay, you may be asked in an examination, okay, you may be given this cash book account, or this cash account, or this cash book may be given, and the examiner say, what was the balance? What was the cash account balance, or what was the cash book balance at the end of, let's say, the end of this month was 30 April, okay? Okay, at 30 April, and this is 30 April, okay? At 30 April, the closing balance at the end of April was how much? Okay. Then the examiner would say, A, it was $9 credit. B, $9 debit. Okay. This is actually a very common question in an Acca exam, in Acca FA1 exam. So you just have to be very, very careful. Okay, you just have to be very, very careful. Here, what it means is this is a $9 debit. This was a $9 debit. The answer is $9 debit. Why is it so? Because our opening balance is on the debit side. Do not exhaust your energy on the balance CD, but you just have to finish up to balance up the account up to the balance. This is what we call the balance brought forward, not the balance CD, but the balance brought forward. Are we together? So the other trick is when the debit or credit is larger, when one of those sides is larger. Like for example, in this case, the larger side was the debit side because it had 99. It had 99 versus how much? It had 99 versus there was only 8 here versus 80. So you can see that the debit side was larger. So where the larger, the side where there is a larger amount, that's where the balance of that account is. In this case, the larger side was on the debit, so this is why we are having a $9 debit, which is the balance brought forward. So the balance brought forward is only going to be on that side where there was a larger grand total, where there was a larger grand total. I'm sure we are done about the cash books, about the account balancing, and we then have to go straight to the business of the day. Okay, we talked about that. Bank reconciliation. What is a bank reconciliation? A bank reconciliation is a comparison. It is, let me just plug in my my machine because it is starting to misbehave. All right. A bank reconciliation is a comparison of a bank statement sent monthly, weekly, sometimes depends on the company. Some companies sent monthly, some weekly, or even daily, all right, by the bank with the cash book. So we are saying that a bank reconciliation is a comparison. So the bank reconciliation is the comparison between the bank statement and the cash book. The belief is that these two items should report same figures. Okay, there should be the same figure here at the bank and the same figure in the cash book. But usually that's not going to happen. So differences between the cash book and the bank statement, as I've mentioned, arise for 3 reasons. Sometimes you might be having errors, usually in the cash book, because it's very rare for the bank to make an error. Okay, so it will be our cash book that will be having some issues. Then omissions. But in Zimbabwe, yeah, there are some people who are actually earning a living after detecting errors on the bank statements. Some banks are overcharging people, and that's another issue. Okay, they might be having some hidden costs, this and that, and you end up having to pay for those ones. But such type of errors are outside the remit of our topic, because we are worried about what the bank has reported vis-a-vis what we have recorded. So we are not actually saying that the accountant should go an extra mile in investigating if the bank charges claimed by the bank is actually the charge that should be done. Well, if it comes to the accountant's attention that such issues are happening with their banker, yes, he has the right to advise his managers to conduct those guys. Okay, but it's very rare. Okay, it's very rare for the accountant to end up doing such work. Okay, so we must not be worried about those issues for now. Let us just consider errors which have happened in our cash book. Let's say maybe we made some errors when we were recording the cash book, so we need to do something. Then omissions such as bank charges not posted in the cash book. Sometimes the figures between the bank statement and the cash book differ because there could have been some bank charges which we would not have considered in our updating of the cash book. Then timing differences such as unpresented checks. Sometimes we might say that, hey man, we have done all the payments according to the cash book, but those payments would not have been honored by the bank or would not have been presented to the bank. Let's say we wrote a check, okay, paying a supplier, okay, but when we went to the bank or when we deposited the check for processing, when we sent the check for processing, it might not be presented by the time we reached month end, and such a payment would be only realized in our books but not effected by the bank, and that will cause some disparities. Okay, you must be certain of the following when doing bank reconciliation statements or bank reconciliations. All transactions have been correctly treated by yourself and the bank. Okay, you just have to ensure that your cash book is actually spot on, is actually up to date. Checks are not written when there are insufficient funds in your bank because a receipt is not cleared at the bank. You just also have to make sure that when you write a check, you are aware that in your bank account there is money. Otherwise, that check might bounce, and what you have reported in the cash book would actually end up being different from what is obtaining on the ground. If you do not keep a personal record of your cash position at the bank, and if you do check, okay, if you do keep a personal record of your cash position at the bank, and if you do check your periodic bank statements against what you think you should have in your account, you'll be doing exactly the same thing that the bookkeeper of a business does when he or she performs a bank reconciliation. So that's what we have been talking about. So what to observe and do when carrying out a bank reconciliation? The cash book and bank statements will rarely agree at a given date. If you are doing a bank reconciliation, you may have to look for the following items. So corrections and adjustments to the cash book, errors in the cash book that need to be corrected. The corrected cash book balance is the balance that is shown in the statement of financial position. So you can see that this cash book is actually a very important book because, especially to auditors, what the cash book is reporting should be the figure that is appearing in our statement of financial position under the the current assets, the cash balance or bank balance. All right. So auditors would go to your statement of financial position as well as your cash book to ensure that there is that consistency of information. Okay, what we have in the cash book should be what has been reported. We do not want to see such disparities. Some disparities where the cash book is reporting this thing and the statement of financial position is reporting that one. That one should be avoided at all costs. So the balance we are seeing in the cash book should be the balance which is going to be reported. Payments made into the bank account or from the bank account by way of standing order or direct debit which have not yet been entered in the cash book, or dividends received on investments held by the business pay directly into the bank account but not yet entered in the cash book, and the bank interest and the bank charges not yet entered in the cash book. So we talked again about all these issues which might render our cash book and bank statement not to balance. Identify all reconciling items due to timing differences. All right. So the reconciling items, like I said they are two, and we are now going to know them. Some check payments made by the business and entered in the cash book have not yet been presented to the bank or cleared, and so do not yet appear on the bank statement. These payments are known as unpresented checks. Okay, they've been made by the business and entered in the cash book, but have not yet been presented to the bank or cleared by the bank. So they have not yet been deducted from our bank account. So such checks are known as unpresented checks. That's the technical name for those checks. Then, on the other hand, checks received. Sometimes customers might write us a check and say, hey man, for that receivable, please cancel my name out and record my payment. And in the cash book, you debit the cash received, but you realize that when you do that, and when you enter that transaction in the cash book and pay the check into the bank, but the bank or the check might not be cleared by the time you reach month end. Okay, and that transaction, while it is being reported in the cash book, it will not be reported on the bank statement. So that type of transaction is known as the outstanding lodgement, or bank lodgement outstanding. Just the same. Okay, so the pro forma bank statement, bank reconciliation statement. All right. So, as highlighted above, once the cash book has been corrected, it should be possible to reconcile its balance with the bank statement balance by taking account of timing differences. Payments made and checks received which are recorded in the cash book but not yet cleared through the bank account and have not therefore appeared on the bank statement. All right. So, let us just change this pen. Okay, once the cash book has been corrected, it should be possible to reconcile its balance with the bank balance by taking account of timing difference. And these timing differences, like I said, ladies and gentlemen, these are just two. That is, payments made and checks received, which are recorded in the cash book but have not yet cleared through the bank account and have not therefore appeared on the bank statement. So we have to see this pro forma here. The first thing is adjusting the cash book balance. How do you adjust it? Just check the cash book balance which you have been given by the examiner. Okay, the examiner might say, hey, at the end of the month, the cash book had a balance of this much debit or credit. Okay, and you now know at this level what it means, or what it means to say this is a credit balance, this is a debit balance. All right, if we go back to our cash book here, we said that this one is a debit balance, but sometimes we might be having. So when we are having a debit balance in the cash book, it means that we are having money, because remember, cash, according to the PO's acronym, this acronym, okay, according to the PO's acronym, cash is an asset. Cash is under asset. The A, that's cash is an asset. So when we have a debt balance for an asset, then we have got money. Okay, we have got money. All right. Then when we have a balance BF on the credit side, they say X dollars. When we have, it means that our CD had occurred, the balance CD would have occurred here. The balance CD would have occurred here. So we take that one here, down here. So what it means is we would have an overdraft. There was a cash overdraft. In that case, our payments had exceeded our receipts. All right. So this side, the credit side would have been larger than the cash. The receipt side. So what we earned, or what we received that month, was surpassed. Okay, was outweighed, was outnumbered by the payment for that month. Please, I need you to listen. Hey, you guys. Hey, Moniki. Hey, Palm Ridge, and everybody else. I'm sure you're hearing me. Please hear me out. Hear me out. Okay. And if you heard me out, then give me a shout out. Just give me a shout and say hello, Agatuta. We are on the same page. Okay. All right. Let's move now. But before again, all right, let me just explain it here. We talked about the bank, all right? We talked about the cash book, but we didn't talk about the bank statement, all right? So it is essential we go back here. Well, let me just look for a different pen. Okay, the bank statement. Bank statement. The bank statement also have got a debit as well as a credit. The bank statement. Now, this $9, which we said that the cash book should report a debit balance, in the bank statement, it is going to be reported on the credit side. Okay, so what is the cash? Our cash book is saying that we are having a $9 debit balance. Then the cash book, the bank statement should say you are having a $9 credit. Why is the bank reporting it as a credit? Because our money to the bank, it is the bank's liability. They have to pay us that money. It's not their money. It's us. It's our money. This is why I put it there. The liabilities are reported with a credit. Okay? Liabilities. They've got a credit. So in the eyes of the bank, our money is their liability. Okay? Our money, which is reported by our cash book as a debit, because it is an asset, our asset, to them, to the bank, it is a liability, because by the end of the day, even if they've got the money in their hands, it is not their money. They have to pay us back. So I'm sure we are now on the same page. Okay? We are now on the same page, This overdraft, when we have an overdraft, according to the cash book, okay, when we have an overdraft, this X here, it means in the bank we are having an X debt. So when you see the examiner saying that their bank statement was showing a debit balance of $9, X dollars, etc., it means that, hey, they were in an overdraft position. Okay, I'm sure we are now together there. I don't want you to be lost in the jungle, guys. The jungle has got lions, it's got vipers, dangerous snakes, so you mustn't be lost there. Let us move together. Okay. Now back to our issue here. This is a very terrible one. Okay, adjusted cash book. The adjusted cash book balance. For you to arrive at the adjusted cash book, when you talk of the adjusted, we are referring to this final balance, the cash book balance, the final balance, that's adjusted cash book balance. So in the exam, the examiner is going to give you, and when I say the exam, even in the assignments I'm going to give you, okay, those assignments I gave you, you guys should take them serious, because the Acca exam is not going to play nice with you. They're just serious people, you know that. They are just serious. They are serious with their accountant's profession. They are serious about it, and they have to guard it. They guard it jealously. So for them to give you a certificate that you have accomplished the FA module, FA1 module, you would have shown some maturity. You would have shown some interest in accounting. You would have shown that you have been taught by the Acca tutor. You would have shown them that you are ready to go to the next level. So this is how we are going to do it. This is how we are going to play the Azondo game. Okay, so you are going to be given a balance. Okay, the sketchbook balance brought down. This is the brought down here. This is the balance given. Okay, given before the errors, before certain errors have been, highlighted. But like I said, in the exam, just consider only two timing differences, which are going to be reconciling items. The rest are going to be treated. They are going to affect the sketchbook. The rest will affect the sketchbook, or nothing, or just nothing else. So in your bank reconciliation, just worry about two things: this one and this one. Outstanding lodgements or unpresented checks. Those are the two reconciling items. Okay, so take everything else to the sketchbook. Just adjust the sketchbook. So you're going to be given a balance brought down, okay, which is going to be given by the examiner. This one, you take it there. Then you have to add or subtract. Okay, correction of understatement, receipts not entered the sketchbook, standing orders, direct debit, etc. If there are receipts which have not been entered in the sketchbook, it means that you just have to have your sketchbook with a debit and a credit. Okay, just have, this is your sketchbook, and I said that the debit, this is where the receipts are, and this side, this is where the payments are. So if they say that there are certain receipts which were not entered in the sketchbook, what you have to do is you take the balance brought forward, or BD, BF or BD, balance brought forward. Let's say you have been told that the balance brought forward was 200, but we discovered that there were certain receipts which were not entered in the sketchbook. So then you have to add to this one, because the receipts go to the debit side. So add receipts not entered. Those receipts which were outstanding, you add them, let's say $80. Then you are also told correction of overstatement. All right. Let's say previously we had overstated the receipts. Okay, when we arrived at this 200 here, we discovered that, hey, we had overstated the receipt. We said a certain receipt, we just said that we received $78, when in fact we had received let's say $68. So that difference, we just recorded a credit entry, okay, over statement of receipts here, $10. Okay, if you still remember, why did I record it on the credit side when it was a receipt which has been overstated on the debit? Because we said that to reduce these guys, the debit, to reduce them, we have to credit them. We have to credit them or open a credit entry. This is to reduce the overstatement. This is accounting. This is accounting, ladies and gentlemen. So you have to think like an accountant, because the path you are going to take is for accountants. So just have to show your maturity when it comes to accounting. So this is why they've written here, okay? You have to deduct the overstatement. You have to deduct from the balance which was brought forward. Then payments or charges not entered in the cash book. So the payments which were not entered, we know that the payments should go on the credit side. So just have to write them. Payments not entered. Then you write the figure. If it was 20, just write 20. If it was 80, just write 80, and so on. Okay? Then you do your balancing by the end of the day, and we talked about balancing of the cash book. Just have to ensure that you balance up. Then the side that has got a larger balance should appear in the grand total. In this case, 280, both sides 280. Then you have the balance CD here, which is the difference 30 minus 280, you get the 250. So this 250, you take it down on the debit side as the corrected balance, the adjusted balance for the cash book. The adjusted balance. That's the balance that is going to appear here on the bank reconciliation statement. So remember, we are having balance per bank statement, okay, this one, and balance per cash book. So your adjusted balance should appear here. This one, this A. That's the adjusted balance. But now, after we do that, let us now talk about the bank reconciliation itself. Okay? Let me change the pens. All right. The bank reconciliation statement, this one. The bank reconciliation. Okay. We are given two balances which should tally. Okay? If they don't tally, okay, X and A should tally. But sometimes they don't tally. If they don't tally, they should be explained by only two things, as I have highlighted. These ones, the outstanding lodgements. Outstanding lodgements, these are checks paid in and recorded in the cash book, but not yet credited to the bank account or to the cash account with our banker. All right. So customers have just given us those checks, but they are not yet appearing on our bank statement. So we call that one outstanding lodgements. Then we've got checks paid by us to suppliers, but not yet presented to the Commons Bank for settlement. So we have given suppliers our checks, but they take those checks to our bank, okay? But our bank has not yet deducted money in payment to those suppliers. So we call that one unpresented checks. So these two are the only items that should appear in your bank reconciliation statement. Are we together? Not any error, not whatever, omission or commission. We are talking of just two things, those two timing differences. They are going to appear in your bank reconciliation. You're not going to find these two items here in the cash book. They're not going to be there. They are not. Please hear me out. These two items are not going to be here. They are not. Okay? They are not. They are not. So do not make that error, taking these items to the cash book and then taking the cash book items to the bank reconciliation. That will be a disaster for your own self. So I want to safeguard your health, your heart, everything. Please do not play with fire. Okay, let me just say, erase these things. Okay, I'm sure we have talked at length, but I just want to finish up with an explanation as to what is happening on this bank reconciliation statement. Of course, we have realized that there are two items that are going to explain the difference between X and A. Okay, X is the bank statement balance. Okay, while A is the cash book balance. The two should tally. If they don't tally, then they should be explained by these two items. All right. Now, if we are given, remember, it is not hard and fast. You may start by the balance per cash book going down, or balance per bank statement going down, just the same. Okay, you can start with either of the balances. All right. So if we start with the balance per bank statement, what do we have to do? We have to add, okay, the checks paid in. All right, because we have recorded those checks. All right, we have recorded those checks in our cash book. So if we start with the balance per bank, all right, we take the balance per bank statement and then add the checks paid in and recorded in the cash book but not yet credited to the bank. Okay, so balance per bank statement, add outstanding lodgement, then less checks paid but not yet presented, okay, to the bank, to the Commerce Bank for settlement. So we have also recorded these payments in our cash book. So we have to deduct from the balance per bank statement so that we arrive at the balance per cash book. It's simple, isn't it? So if you start with the balance per bank statement, you then have to say add outstanding lodgement. Okay, outstanding lodgement. Sometimes in layman's language, outstanding lodgements are receipts not yet banked. Okay, it's like a customer's come even with their cash, hard cash itself. Okay, they've paid. Let's say today is a Saturday and month end is tomorrow. Okay, or it's a Friday. They've come on a Friday when we are left with only one day to month end. Let's say today is 29. Okay, we do our bank reconciliations on the 1st of every month. All right, so on this Friday we received money. We can't, and it's almost late, we can't take the money to the bank until Monday, right? So we keep the money in the safe. So those ones are receipts. We've received money, so they are receipts. We record them in the cash book as the receipts, okay, but it is not yet banked. So similar, they are just outstanding lodgements. Outstanding lodgements, they are checks which we have received and we have recorded them. We have recorded the check, but the bank is not credited. It's not yet cleared those checks. Even if when we took them to the bank, maybe because of system challenges or because they would do such check clearance maybe on a Monday. So they are not yet credited to our bank account. So it's just the same, right? So you just have to know that outstanding lodgements, these are checks from customers, okay, and we have recorded them in the cash book, but they are not yet credited to our bank account. When you are saying crediting, just remember that if we are crediting, if the bank is crediting something to us, or when we are crediting to our bank account, a credit is money to us. It's different from a debit in the cash book, okay? I mean, it's different from a debit in the bank's eyes, okay? Remember, to the bank statement, when we are having a credit, this is money, that's money, okay? But debit is a reduction. This is a reduction, but this one is an increase of money, okay? Why? because to the bank, our money is their liability, but to us, it's money because we are increasing our money in the account. All right, so this is why we are saying that checks not yet credited to the account, credited to the account by the bank. The bank credits our account when we put money inside that account, or when customers put money in our bank, the bank credits us. Why? Because it is acknowledging a liability. They are going to pay us that money. It is not their money. Okay, so please understand this table, understand this way or that way. Okay, you may move from the balance per cash book going upwards. Okay, if you start with the balance per cash book, it means that instead of lessening, you will be adding. Okay, here and here, you then have to lessen. Okay, if you start from the cash book going up, all right, start from the balance per cash book, then you have to add unpresented checks, okay, and less receipts not banked or acknowledgement, outstanding lodgements, and then you come to the balance per bank statement. I'm sure they have re-emphasized and emphasized. So let us just do one example and we call it a day. Just one example to understand what would be going on. Okay, that's the example I'm talking about. We just have to do this example together so that we know where we stand and where we don't. All right. So when you are faced with these issues in an exam, please breathe. Just take a breath, and then you find that, or you discover that you are just as fine as possible. All right. So at this September 2009, the debit balance in the cash book. The debit balance in the cash book of Tim Brooks was $805.15. So the cash book was having a debit of $805.15. That's our balance brought forward. Debit. Okay. So according to this cash book on 3rd September 2009, the company had money. A bank statement on 3rd September 2009 showed Tim Brooks to be in credit of $112.30. From on investigation of the difference between the two sums, the following items were established. So these items were established. Okay, they were established. The cash book had been undercast on the debit side. This is a cash book error. This is a cash book matter. So in the exam, just have to say, hey, this one is a cash book. Okay. Then checks paid in not yet credited by the bank amounted to $208.20. Checks paid in, okay, not yet credited. Not yet credited. These are bank lodgements, outstanding lodgements. So these outstanding lodgements. So is this a cash book or a reconciling item? This is a reconciling item. Reconciling. RC. Just put an abbreviation which will not confuse you by the end of the day. Because it's not hard in fact to say you must write an RC or say reconciling item. The examiners just do not care. They don't give a damn. They don't give a damn. Okay? Or they don't care a straw. They don't care. Yeah, they don't care. They don't give a damn. Okay? So you just have to mind you. You know, in the exam, it's a matter of speeding and everything else. So you just have to up your skill, up your skill and your stamina to ensure that you pass. I'm sorry, but I just want you to enjoy the lecture. Okay, just enjoy the lecture. All right, so you must have very, very, very alert eyes. Okay, very alert eyes. Okay, just have to be alert. Okay. Checks drawn, not yet presented to the bank. This is a check that has been drawn, but it has not been presented to the bank. So these ones are unpresented checks. Is this a cash book or a reconciling item? Obviously, this is a reconciling item. Okay, so what do? We know that the procedure is we first have to make sure that our cash book is smart and neat. So we have to update our cash book first. That's the first stage we have to do. So we have been given the balance brought forward here of 80515. Then we have to correct it. We have to adjust it with the cash book error here. The cash book has been undercut. So on the debit side. So the undercut was on the debit side. So we have to add to this debit side. So undercut. So just say add undercut. Because the cashier had undercasted the balance. Okay, so we have to add the difference to ensure that we come to the right balance. So here 895.50. This is the adjusted cash book balance. Okay. Now the bank record. Bank reconciliation. Okay, the bank reconciliation. We can start with the adjusted cash book. Okay, so balance per cash book. That's 895.15. Where are we taking this figure from? We're just simply taking it here. From this. Okay, that's the figure we are talking about. Then you still remember, okay? If we start with the balance per cash book, we then have to add unpresented checks here. If we start with the balance per cash book, we then have to here just cancel the less and say add unpresented checks paid by the company but not yet deducted from our bank or not yet presented to the company's bank for settlement. They're just orders to pay but not yet processed. Okay, so we then have to add. We still have that money, so let us just add. Okay, add unpresented checks, unpresented. If you don't give a thumbs up to me here at this stage, then hi man, you're just rough. Okay, you're just rough. All right, then so unpresented checks, where are they? These ones, checks drawn not yet presented to the bank, amounted to 425.85. This is add, and then you have to less bank outstanding lodgement, and outstanding lodgements of 208.20. Before we do the mathematics, I want you to tell me what type of a balance are we going to get there? We must get this balance should tally with this. Why? Because we started with the bank, the balance per cash book. We started with the balance per cash book. We just have to rest our case with the balance per bank statement. Balance per bank statement. Because remember, the purpose of the bank reconciliation is to ensure that we have similar, we understand why, the difference, or we make a comparison between the balance per cash book and the figure, the bank statement. Because by the end of the day, these balances should tally, should agree with one another. But on the ground, they do not agree, and we have sorted out those issues. We first correct our cash book or update our cash book, which we did here. Okay, we have updated our cash book, and then we do the reconciliation. The reconciliation, we say that there are two items, this one and this one, which should explain. Okay, this item should explain. So this one is a negative because we are lessening here. So if we do the mathematics, we must find, let's use our calculators. Let's use our calculators so that we move nicely. 895.15 plus 425.35 minus 208.2, we get 1112.3, and this is the same figure here. If you see this, if you come out of the exam with this type of mathematics done properly, then you must assure yourself that you have passed the exam. You have passed the exam. All right? So I want you, ladies and gentlemen, to go and read the slides which I have given you. All right? And attempt as well example number 2, and I have given you the answer there. Before you start the assignments, okay, and this time we are now doing everything on the CBE environment. Okay, we are not going to write anything down, this and that. Okay, you're going to write whatever you're going to write. You're going to write on the provided answer sheet, system generated answer sheet, where just have to be used to the computer-based examination environment, so that on exam day you're not going to be taken unawares. Remember, we are thriving, and striving as well to ensure that you guys up your skills, up your bars, so that you pass on exam day. None of the Transcal Consulting Services students should fail. Okay, you just have to make it on the first bound, and you go to the next level. I'm going to be there for you guys, and I welcome and I appreciate your support. I know recently the school has upped their their tuition fees, but we're just trying to keep abreast, to keep in pace with the changing times and the costs of administering this Chartered Certified Accountants program. Remember, by the end of the day, you just have to be quality accountants, the professional one, so that you just have to match in terms of your knowledge, skills, and professional behavior and professional competence with those guys who are learning the same qualification in the United Kingdom, in Botswana, in South Africa, in Australia. By the end of the day, your skills should tally. So this is why we are thriving, to ensure that your experience, your learning experience is actually at par